So I've started recording. Thanks everybody for joining in. Before Amit begins, just a small little announcement. Next weekend is going to be very interesting. The next generation is going to present their musical talent. So the registration link for that will come up later today, or maybe while the session is on, I might churn out the registration link. There's also going to be one more from Renata immediately after that, the weekend after that. So you'll see it. You'll see that registration link too. So just wanted to let everybody know that there will be two registration links coming. Don't get confused. Please register for both. And hope to see you next weekend on Independence Day for the kids first, and then for Renata's the thing. With that, over to Amit. Amit, over to you.
All right, guys, can you hear me fine? Nagesh, are you still hearing me okay?
Yes, I can.
Okay, no background noise or anything. Okay, great.
No background noise.
Thank you.
Yes.
Thank you everybody for joining me. I'm not the expert on this. I'm sure there are a lot of people who are in our group who are as well versed as I am or even better. What I'm trying to do here is trying to put together some ideas or some guidelines for the 99%. So some of us might want some established guidelines to use, some might want some theoretical frameworks to think about retirement, about financial independence, and so on. And that's what this effort is. So as Amit Jain mentioned, I'm sure some of you will know more about this topic than me. Feel free to pitch in if you do know something that I don't and I'm not stating something correctly. So today's class is about free to fire, an easy path to financial independence. That's financial independence for the 99% of us. There are 1% of us who don't need any help. This is not for them. This is for the 99%. So before we get started, though, little bit of boilerplate language. This is not considered as advice. I'm not telling you go out and buy something or put all of your life fund in something or the other. As always, make sure you use your own common sense, do your own research, and if necessary, go seek an independent financial advisor to make your own retirement choices, because everybody's retirement, everybody's finances are their own personal things. And there may be a lot of things there that are not considered in this overview. I'm giving you a very general overview, and it's up to you to go and dig down deeper into it and investigate further into it. And I'm always ready to help if anybody needs to talk to me. So just a quick review of survey, and I will go through the bigger survey questions later on. But just an overview of the industry that people work on. Looks like most of the people are IT, finance, there's some healthcare, energy, education, and so on. A little bit of everything. So considering that we all started with engineering, it's very interesting to see that about half of us are still in engineering related topics. Half of us have moved on to various esoteric topics like finance and accounting and media and retail, etc. So very interesting to see. So what is financial independence? When you take a look at it, you have to see the rat race. So as soon as you graduated from college, probably even before you joined KREC, your parents were telling you, study hard, get good grades, go to school. And once you're in KREC, your aim, at least for some of us, was to get high grades, other was to get good jobs, work hard, study hard. And then we go into our jobs, we work really hard to get our promotions, we earn more money, we get more promotions, and then we get stressed. And then we start buying stuff to make us happy. So in all of this race, every time happiness seems to be just around the corner. You do a little bit more and you'll be happy. And this race continues. It seems to be like we're constantly running, trying to do ever better and better. When do we get out of it? I mean, at some point it gets so stressful to some people that they think, okay, I wish there was a way to get out of the rat race and into something different. And as I mentioned in the previous slide, nobody on the deathbed has said, I wish I'd spent one more year in the office. Rather than saying, I wish I'd spent more time with my family and friends. So that's what the goal is. So financial independence means different things to different people, but essentially it's having enough money so you don't have to depend on a job for the rest of your life. So you have enough money that you've earned, saved, invested, and that money is going to give you the returns that you need to live your life as you see fit. So this is a survey question that I asked many of you. So how much time do you spend with your friends and family? So very few people say very little. My job keeps me so busy. A big chunk of them said, I have plenty of time I spend with my family and friends. But more than half said, I don't have as much time as I like, but I spend as much time as I can. So, and more interesting was, if I had more than enough money for the rest of my life, only 1/4 of us says, I will continue at my current job. I love my job so much, it doesn't matter, I wouldn't stop. More than half say, I will quit and find something more interesting in doing. And about 20% say, I will quit and enjoy life with my loved ones. So that's very interesting. Financial independence and retire early. The retire early part is an optional part. It does not mean that you have to go sit on the beach and sip coconut for the rest of your life. That's not what financial independence is about. Financial independence is about giving you the freedom to take any step that you want in your life. It could be you have a boss that you don't like and he's making you do things that are not ethical, or keeping you away from family, they're not interesting. Your company is maybe in a declining situation and you want to get out of it. Maybe you're interested in doing non-profit things. Maybe this corporate rat race is too much for you. You want to go and help the people do education. Somebody mentioned Swadesh the other day, go to a village and do something for your hometown. You want to educate your kids, you want to spend more time with them growing up. Financial independence opens up a lot of possibilities, even including sabbatical. Let's say you're getting too tired of your job, but if you are not financially independent, you can never stop working. If you have financial independence, you can say, okay, I'm going to take a year off, I'm going to go see the world, and then I'm going to refresh my mind and come back. So financial independence makes all this possible. And the retire early part is actually a bonus. If you want to, you can retire. If you don't want to, you can continue doing what you want. So when we look at the FIRE world, this has been, the name FIRE itself has come recently, but this has been a concept long existing, where people say work hard, save as much as possible in the early part of their life, and then try to retire and do other things. So there are a number of terminologies that we can come across in this space. One is fat FIRE. FIRE itself is financial independence, retire early. But fat FIRE would be somebody who says, I want to going to live my best life. I'm going to have luxury. I'll be traveling all the time. I'll have fancy houses, nice cars. I won't have anything that I'll be lacking for. When I retire, I want to make sure I have enough money to support all of my needs. So that's fat FIRE, where somebody has done saved a lot of money. The other part is lean FIRE. The opposite end is, I want to save just enough money for basic expenses. I'm going to live simply. I'm going to move to a low cost of living place. I'm not going to have heavy expenses. I don't want to do a lot of work, but I'm happy with the simple life that I'm leading. The next is coast FIRE. So coast FIRE would be investing early into your work, saving and investing a lot of money. Then you stop after you hit a certain milestone. You stop investing, and then you take life easy. You work at your own pace. You don't stress about the career promotion, raises, and so on. But you leave your retirement untouched, and you don't need to contribute anymore. So the rest of your life, you can spend all of your money that you're earning and not have to worry about retirement. So there's some people who like to live risky. So they say barista FIRE. I'm going to save a little bit of money, and then I'm going to take a part-time job. Some people say you can even be a barista in Starbucks. So there you'll just get the health benefits, basically a little bit of expenses. My social activities, I'll be interacting with people, so I won't be bored. So it's not complete retirement. I'll be doing something part-time because it's interesting me. The last one is cash flow FIRE. So some people, instead of saving a lot of money into stocks and bonds, they will go and invest in a different model, which will generate them income on the side. So while you have a job, you start your blog or you start a real estate business. I was talking to somebody the other day in our class who said that they're going to go into commercial real estate. They're going to buy real estate properties and use that cash flow to buy more properties and more properties. And then sooner or later, that's going to generate enough cash flow for them to sustain them for the rest of their life, and they can quit their main job, and their side hustle becomes a main mode of operation. So they don't need to worry about working for income. There'll be something that's generating income for them on the side. Any questions so far? Just making sure audio is still working. Just somebody just say hi.
Audio is still working, man. Beautiful.
Okay, good.
Yeah, and no doubts whatsoever. Very clearly explained.
Okay,
Everything
great.
good, everything good.
Perfect. So the biggest question that comes is, how much do I need to retire? I'm working really hard. I'm saving a lot of money, but I don't have an idea of how much actually do I need to save in order to retire. And there are some simple rules to go with that. One rule of thumb that people talk about very often is 4% rule. How many people have heard of the 4% rule? Just a quick yes would be would say sufficient.
Not me.
Not me.
No.
Okay. So not a lot of people have heard. So basically the rule is very simple. So you want to earn enough money so that you can withdraw 4% of your savings starting from the first year of retirement, and that will last you for the whole retirement period. So every year you withdraw, for the first year you withdraw 4%. Next year you withdraw that same amount of money plus inflation, whatever the inflation is. Let's say inflation is 3%. You increase your amount by 3% and withdraw that money and let the remaining accumulate. And the year after that, you add again inflation, withdraw that money. So that basically gives you a good rule of thumb. So what do you do with that? So what you do with that is take your expenses in retirement. You estimate how much you're going to use in retirement, a certain amount of money per month, per year. Take your annual expenses for the year, multiply that by 25. Where did that 25 come from? That 4% basically means if you want to withdraw 4%, you need 25% of that, 25 times that amount to get 4%. So hopefully that's clear. You will calculate your annual expenses and take 25 times that number to come up with your retirement number. So I'll give an example of what that means. Let's look at the central one for now. I'll look at the most common case and example. And you'll have to forgive me here. There are about 75% of people from India who answered the survey, 25% in the US. And one thing you have to realize is the cost of living and the earning levels are different in different countries. So at the bottom, I have put in $1 is 75 rupees nominal. But when you consider purchasing power parity, how much does $1 buy in India versus $1 in USA? $1 is equivalent to actually 25 rupees in purchasing power parity terms, even though it's 75 rupees nominal terms. So with that in mind, let's take a look at this example. You have this guy in the center.
Sorry,
yeah, go ahead.
what's the retirement age you're assuming here?
Retirement age doesn't matter. This is a retire early, right? So what is more important is when are you ready to retire is when you have the amount you saved up. So retirement age could be 65, could be 45, could be 30 if you already had retired. But it depends on how many years you have left for retirement. So you calculate a life of 90 years, 100 years, and you would say, okay, I'm going to my years left for retirement are 30 years, 40 years, 50 years, 60 years, and you'll see how much money that you have left. I'll go into a little bit more detail about the amount of time left.
Okay.
Hey Amit, one
ahead.
question. Can you
Yes.
please explain this purchasing power part again, like $1 75 nominal 25?
Okay. Yeah, purchasing power parity basically means if you go buy something in a country, let's say you want to go for a lunch in India, you would spend a certain amount of money. Let's say 50 rupees, 100 rupees, 250 rupees, 300 rupees, whatever amount of money you spend for lunch. If the same amount you want to spend in US, you probably be spending 3 times as much money in the US. So $1 or let's say $10 in the US, if it buys you lunch, then an equivalent lunch in India would be, let's say, $3.50. So
Okay, got it. Thanks.
that money goes further in India compared to the US. And hence you would see the income is also similar. You have lower income in India compared to the US. So ultimately it all balances out. If people earn in one place and live in that place, it's usually adapted to the amount they're earning and amount they're spending. But there are some interesting possibilities, as this can show. When purchasing power parity is different in different places, you can use geographical arbitrage, go from a high cost of living country to a low cost of living country or a location and spend that money. So that's getting a little ahead of ourselves. Let's get back to the example that we have. I have here an example of $40,000 for somebody in the US, let's say $40,000 is his estimate for his annual expenses. So that is roughly 30 lakh rupees in Indian nominal funds. But if you look at purchasing power parity, that will be like 10 lakh rupees in India. So about an 85,000 rupees per month spending level. Think of that, a person who's at that level. So, okay, so what does that person need? So 40,000 if he wants per year, 25 times that is $1 million. So that's what he needs to save. And if you take a look at that same 10 lakh, if I make it 25 times, 2.5 crore, that's the fund that he would need to use. That's when he says, okay, if I want to spend 10 lakh for 30 years, 2.5 crores is enough for me. So is that clear?
Hey, Amit, this is Monty. I had a question.
Yeah, that's clear.
Yeah, go ahead, Monty.
So is this number per person or includes your spouse or significant other?
It includes your spouse. So this is your family net expenses and spending. So you will consider all the responsibilities that you have, and this number could be higher or lower. I just chose a number in the middle because there is so much parity between different countries. I just chose different representative samples, 20,000, 40,000, 80,000. So 5 lakh, 10 lakh, 20 lakh per year. But if your spending is double of this, take all the numbers and double this. If your spending is half of this, take all these numbers and half of it when you look at these numbers. So to answer your question, it's for your all expenses, your family, you, your spouse, your children. After a while, they're not going to be at home, so don't count your children forever for the rest of your life. Hopefully, they'll be independent and go away. The schooling will be finished, and all those expenses will be gone away. So, what is the amount that you and your spouse will need to retire?
Monty, only one spouse, huh?
Okay.
Especially for Monty, right?
Yes. Yeah,
Amit, focus, guys, focus. Come on.
Just one question, Amit.
Yes, go ahead.
Yeah. So in this case, will you consider your immovable assets also in this net worth calculation, target retirement fund, or it is only liquid?
In your net worth calculation, I tend not to. I only count 50% of your immovable calculation. So at one point, I'll say, if you want to be financially independent, buying a house to live in is probably not the right investment. Especially if you're spending a lot of money and significant chunk of your net worth is tied up in your personal real estate, that is not really generating income for you in retirement. So you need to have income that after inflation is generating 5% or more retirement. So your own net real estate is not going to be helping you. But if you own rental properties, that certainly counts. It adds towards your income generating ability. Is that clear?
Yeah, I meant the rental properties only.
Yeah. Well, rental properties, yes. Rental properties, if it's generating more than 5% income after your inflation, then that's good. Somebody else had a question.
So, Amit, this is Bala. In your previous slide, you said you need to have 25 times the 4% in order to live for 30 years.
Yes.
So, are you accounting for some interest on the amount?
Actually, this counts for all of it being invested in the stock market. I will have assumptions there that let's say your whatever fund that you have, let's say you have $1 million or 2.5 crores that you have invested in the market is generating you income, is generating you more than 5% income after inflation. So it assumes that you're getting enough money and you're being conservative and taking less than that. You're taking 4%, and that's because of sequence of returns risk, which I'll cover later on, where the average return may be high, but on a year-to-year basis, there may be a lot of fluctuation. So you want to be a little bit conservative in spending. So
it accounts for some appreciation of the initial.
It accounts for appreciation, yes. So this amount. This is 40K in the first year, but after the first year, it's you add inflation to it. Let's say inflation is 2%, you add 2% to this amount, it'd be like 41 lakh or whatever, $41,000 or 12 lakh or whatever it is. So every year you'd increment it. Yes, go ahead.
Amit, Subhash here. Is this that 4% withdrawal? Is it particular geography like US or India, or is it across the world? What's that safe
across the
withdrawal
world?
rate?
It's across the world. So That's a very good question. So let me backtrack a little bit and say where this 4% will come from. There's a guy called Bill Bengen in 1994 who looked at historical analysis of the stock market. And for that study, the main target was the US market. So he took a 50% US stock market, 50% US bond market, and had a portfolio of that and did some testing over 150 years. So starting from 1879, since the stock market started in the US to now, he looked at rolling period of 30 years and considered a person who's retiring at any different year, given year, if for 30 years, if we was to withdraw, he tried different withdrawal rates, 1%, 2%, 3%, 4%, 5%, 6%, 7%, 8%, a variety of rates, and said, what is the safe level for you to withdraw the money? So while the thought process is based on the US market, in general, if you are getting more than 5% after inflation, 6% after inflation, this should apply to other markets as well. So this is independent of US market or not. It is independent of the amount you have. It just is a multiplier of your expenses 25 times, whatever that is, whichever currency it is, whichever stock market it is, it does not matter.
Okay. All right. Awesome.
Okay.
Thanks.
Good. So, so let's look at the lean, for example. Let's say somebody who can live on $20,000. This is now in the US is a very difficult sum to live. You have to maybe live in a really small place, in a rural place where the rent is cheap. You have to eat simply, survive difficult, and an equivalent amount in India might be 5 lakh rupees. So it's technically not that bad because the majority of India probably earns way less than that. So this is still higher than average in India. So while we call it lean fire, majority of Indian people live way below 5 lakh rupees a year. But still, this is considered lean fire where you are trying to be careful about expenses. You're not spending a lot of money, and consequently, you need much lesser fund to live. So here in this example, you need 1.25 crores if you look at purchasing power property, or 3.75 crores if you look at nominal. That's what you need to live. And if you have that amount, then this will give you 15 lakh or 5 lakh rupees every year for 30 years or period or more. Why do I keep mentioning 30 years? Because typically you consider a time period, historically people used to retire at 65 and they had like 30 years to live. By 95 they were dead. Now people are retiring earlier and earlier, and this assumption changes slightly. From 30 years you have to consider a little bit more, 40 years, 50 years, 60 years retirement, especially people in our case who might live 50 years more. So think about this. And on the other side, you have fat fire. Fat fire is typically people who live above the average income of the country that they're living in. So let's say the median income in the US is about $50,000. Somebody who's living $80,000 would be considered fat fire. If I convert it into Indian purchasing power parity, let's say 20 lakh per month, 20 lakh per year. If somebody is spending it, that would be much higher than typical people are spending. And if for that amount of spending there to support it, you need about 5 crore rupees of retirement funds.
Yeah, Amit, in these calculations, does it include the social security benefits? That does not include.
Very good question. Social security benefit does not include it. So that is something on the plus side. So people who have pensions coming in, or so in the US, you have social security where at 67 years of age, you get certain amount of money, let's say $20,000 or so on. That's additional that comes on top of it. But it's not always good to count on that because, as we know, the social security system is not very robust and it might crash, or the benefits may go down to 70%. So
kids college also not included, right?
What's that?
Kids college also not included. Obviously.
Kids college not included. All of these expenses are assuming that you have gotten rid of all these expenses, and these expenses are afterwards. So if you have kids college, probably this amount of money is not enough for you. So you all have to save more for that amount. So so kids college is not included. But one thing I like to say is there's always a loan for kids' education. There's no loan for retirement. So be careful, too careful about spending a lot of money for your kids' education and then having really left over with very little money for your retirement. it's always possible for the kid to pay back a loan rather than for you to get a loan for your retirement. You cannot live comfortably by going to bank saying, I want a loan to retire. But bank will always give somebody who's going to school and has earning potential, they can always give you a loan. The kid can get a loan. You can always support the kid, but be careful that you don't sacrifice yourself to make sure your kid has zero loan starting in life.
Amit, what about medical expenses, especially serious ones and etc.? I guess that's not, and it will change this equation quite a bit. And especially given that retirement would happen and most of us will get older, right?
Yeah. So that's a good view. I'm going to defer that to a little bit the later section where I talk about 4%. I'm going to talk about different variations of that. So just hold on for a second.
Amit, just one question on this sum.
Yes.
This is Praveen. So basically, this 5 crore or 2.5 crore, this is your money that is generating income for you. That's the kind of sum you're talking about.
Yes, 2.5 crore is generating you 10 lakh per income per year.
Okay.
And that's income you used. That's the withdrawal you make. It's actually generating more than that, but that's a safe withdrawal rate for you to take 10 lakh rupees every year. And it has to be fully invested in the market in various funds. Yes, go ahead.
Good. Okay, got it.
Okay, good. So, like I mentioned, this 4% rule is kind of a rigid rule. It says every year you have to increase it by 4%. And even if the stock market crashes, you still need to, you continue to withdraw the money, even if your funds are going down. So there is some relaxation that is possible. The other thing is this study considered a specific portfolio, 50% stocks, 50% bonds. This might be a very conservative portfolio for some, might be aggressive portfolio. But in general, for people who have long life frames, this is a very conservative portfolio, and you need to have more stock exposure, which I'll cover in a minute. And it uses historical returns. So you always have to be careful about it. This looks at maybe 100 years of stock history, but past performance is not always guaranteed future results. So you have to be nimble, you have to be flexible, keep an eye on the market, keep an eye on your funds and see how they're doing before taking anything at gospel. So this slide, for people who are seeing it on a phone, might be very small. So forgive me if that, but if you're seeing it on a screen, this talks about variety of different scenarios. So you have the one that I've highlighted in the middle is a scenario of 50% stocks, 50% bonds at 4% retirement. Hopefully you can read all of this. So what it's saying is there's a 95% chance of success for 30 years. If you look at a 30-year period, there's 95% chance of success that your retirement money will not go down below zero. And in many cases will even exceed the starting amount. So because in the vast majority of cases, the stock market growth is going to give you more money. But as people who are conservative, who has to look at the downsides, we have to look at the 5% of cases that may not work. And what happens in that cases is, as soon as you retire, if you have a series of bad years, that might cause a little bit of risk for you. That's why there's a 5% risk. So there are two aspects in this chart. One is to look at more number of years to retirement, 30 years, 40 years, 50 years, 60 years. Let's say you have a lot of medical expenses that you're coming in. As you look at this chart, you can see from the top 100% stock, 3% withdrawal rate to 5% withdrawal rate in 60 years and 0% stock. I've only put my money in fixed deposits or bonds and I take 5% every year. That means there's a 7% chance of success. So it means you'll be successful 7% of the time. Majority of the cases you'll run out of money if you do that. So always go up on the number of stocks. So 0%, 25%, 50%, 75% or higher is the stocks that the amount of stocks that are recommended. The other is 4% is good, but if you have 50, 60 years to live, you probably want to reduce the withdrawal rate a little bit. So from 4%, so say to 3.5%, now you go to 100% success rate. So what that means is during this whole 30-year period, there's no failure condition. If you withdraw 3%, then you're always successful. There'll always be money left over for you. And as you go increase your higher stock, you can increase your withdrawal rate as well. So at 3.75, at 75% stock, you have 100% success rate in your retirement. Is this chart clear? Is there something that I can explain better here?
It's clear, Amit. So are you suggesting that we need to sell the stocks every year?
No. That's not what I'm suggesting at all. This stock is just looking at your asset allocation. It says 50%
No,
stock.
I get it. I get it. How do we withdraw the money?
Okay. That's a very good question. I'm going to come to it in the second half.
Hey, also, what is the return you're assuming here for stocks? Annualized.
Greater than 5% after inflation. So 5 to 6% after inflation.
After inflation, okay. So meaning 5 to 6% plus inflation, right? Basically.
Plus inflation, correct.
Yeah.
And you're withdrawing 4%, 3.74%, 3.5%. So that's the rate.
Yeah.
So the general success factor is if you can be conservative in withdrawal rate and you can be more aggressive in your portfolio allocation, the more chance for success you have in your portfolio. And let me take this example and go back to an example of somebody who spent 10 lakh rupees or $40,000 per year. Let's take a look at what that does to his target amount that he wants to spend and save. So we talked about earlier, we have the middle case where you have maybe a middle of the road investor in 40,000 is a very middle class life in the US. I don't know about India. I'm assuming 10 lakh is also a very middle class life. But if you want to do 25x,
10 lakhs in India, just to add, it's certainly you'll have to select a very small city if you want 10 lakh rupees for middle class life. Yeah.
Yes. Agreed. So then you might be take a look at the next level, which is $80,000, which is 20 lakh rupees.
Yeah.
So we calculate this. We already calculated 25x at 4%. You 25x. But if you do 3.5%, you do 29x. How did I come up with this number? It's basically the reciprocal. 1 by 3.5% is roughly 29 times. So that gives you the withdrawal rate. Gives you the multiplier that you need. How much money that you need to save is a function of your withdrawal rate. So at 3.5%, from 25x you go to 29x. So from $1 million, you need now $1.15 million or 3 crore rupees. If you go to 3%, for the same 10 lakh guaranteed income, you now need 3.5 crores. So what this shows you is if your withdrawal rate gets more conservative, you need to save a bigger amount of money. So you need to save a minimum of 3.5 crores in order to be able to retire and withdraw only 3% of it every year. So that's an impact of how the withdrawal rates change and what that does to your target amount. So this gives you an idea of how much you need to shoot for.
So Amit, are you saying that if you withdraw less, you will need more corpus?
Yes. If you're withdrawing less, because you're withdrawing less as a percentage, but remember the 10 lakh is the same. I'm withdrawing the same 10 lakh, but it is a smaller percentage of a bigger number. Is that clear?
Yeah.
So when I have 2.5 crore, I can withdraw 4% and I can get 10 lakh. But if I have 3.5 crore, I have to go down to 3% to get the same 10 lakh.
Okay, so I adjust my withdrawal rate. Okay, yeah.
Your withdrawal rate is lower, but your amount that you're withdrawing is the same because your expenses are your expenses. You're not changing how much you need to live on. You're just changing how much you're withdrawing percentage per year.
Yeah. Okay.
In effect, it's no longer 25x. It's more than 25x that you have to save. That's what.
Exactly. So exactly. If 33x, if you were more conservative, 33x is what you need to save. About this FIRE thing is it's not about how much you make. It's about how much you save. What are your expenses and what are you willing to save and to earn? So people who retire, Mark Zuckerberg will probably never retire because even though he's at $100 billion, they want to continue living. But a school teacher in the US can save 50% of the salary, or 40% of salary, 20% of salary, and at some certain part of the time they can retire. Even if their income never gets as high as some of these people on the previous slide, or even if their total net worth never gets lower, as long as your expenses are within the envelope that you have, then you can retire safely. So that gets us to the next question. So we have identified target. So I know how much, but how long does it take and how much should I save? That's a very interesting question that most of us have. And let's take a look at the savings rate of some of the people from our class. About 0 to 10%, 8% of people are saving very little for retirement. Only maybe 0% or 10%. Some people are saving 10 to 15%. Some people are saving 15 to 20%. There's a big chunk of 20 to 30% seems to be very popular, 20 to 30. And a nice chunk of 40 to 50% who are saving, so saving essentially half of their income. So quite a good job in general. So the math goes, for savings rate, there's no specific number. It's save as early as you can and as much as you can. On the right, I have a certain chart, but before that, the assumptions, 5% in investment returns after inflation during a savings rate, and you leave off the 4% after retirement with some flexibility. If there is a recession, you'll cut down your expenses, and if there is a huge stock market growth, you'll increase your expenses. But in general, you live within your expense profile. So what this says is, if you're starting from zero, this is not you guys' case, where you've already been saving for 20 years. This is somebody brand new starting from scratch. And if he has a certain amount of income, if he saved only 5% of that income and he needed 95% of that income to live, he will need 66 years more that he'll have to keep saving in order to retire. If you jump to 20%, that means you have 37 years working left for retirement. If you jump another 20%, you have 22 years left for retirement. So the sweet spot is, if you're saving 50%, that person can retire at 17. So imagine you are, let's say 21 when you graduated from KREC, you're saving 50% of income. So at age 38, if you're saving 50% of your income every year and you can live in the remaining 50%, in that 38 you are independent. You can stop working and for the rest of life enjoy that money. So what this goes to say is, it's not how much you make, but it's how much you save. How much you save is the key part of retiring early, of becoming financially independent. So the more you save.
Hi, Amit.
Yeah,
sorry, would you please explain the chart on the right again, please? I didn't quite get it.
Okay, so
thanks.
What this chart on the right is, let's say you make 100 rupees, and out of that 100 rupees every year, you save 5 rupees for retirement. And that 5 rupees for retirement will grow at 5% rate for the rest of your life. What that means is, if you only saved at 5%, then you need 66 years to retire. If you saved at 10% rate, then you need 51 years to retire. If you saved at a 30% rate, you need 28 years to retire.
Perfect.
So,
got it. Thanks.
So people who are close to retiring are probably people who have been, over their lifetime, have been saving a big chunk of their money, 30, 40, 50% of the money, and investing it. That will bring them sooner to retire. And if you're saving less just because you have a lot of expenses right now, it's understandable. In some cases, life deals us an unfair hand, but in every case, you have to see how you can reduce expenses and try to increase your retirement. And the key part of it is save as early as you can. The best time to start saving is 20 years ago. The second best time to start saving is today. Saving tomorrow does not have the same effect as saving today. So if you start today, that's what you can retire sooner. That's the whole goal of this slide. And why do we say save more money, save more money? We saw the rat race earlier, where we earned a lot of money, got successful. We tend to buy things to make us happy. We got a new promotion, let's buy a new car. But the whole thing about it is, if you spend more money, does not necessarily mean you increase your happiness. There is something called like a hedonic treadmill of adaptation. So you go and buy, let's say you live in a small house, or 1-bedroom house, you go to a 2-bedroom house or a 4-bedroom house, and you're very happy for 3 months, 4 months, 5 months, 6 months. But after a certain amount of time, your happiness again returns back to your base level. So you are at this level of happiness. You go out and make a purchase. Your happiness goes up. Some good stuff happens to you. And then gradually it comes back down here, because you adapted to it. This is a new normal level. I'm making so much money. I'm spending so much money. That's how much I need now to be happy. Now I need something to raise the happiness. I need to go to the next level and the next level. And the hedonic treadmill basically says you have a base level of happiness. Even if bad stuff happens to you, you'll be unhappy for a while, and then time heals all wounds and you come back to the same level of happiness. Whether you're poor, whether you're rich, everybody comes back to the same level of happiness. So spending more time, more money does not increase your happiness, and hence spending all of your life to gain money also does not bring you happiness. That's the story behind this. So where do we cut expenses? We mentioned we have to save for 40, 50%. Where do we save expenses? So there are a lot of expenses that we all make, and every time we feel happy, we get a promotion, we make a new purchase, we buy gadgets. Everybody wants to buy now the Samsung Note 20 Ultra, which is $1,500 minimum. Every year, every 2 years, you want to upgrade your phone. You want to buy, you saved up some money, now you want to buy a brand new car because your car is now 3, 4, 5 years old, but maybe it's time to get a new car. Why not drive the old car? Because the new car is going to make you happy for 6 months, and after that, your level of happiness is going to come back to the same level. Subscriptions. You have expense in the US, you wouldn't believe cable bills can go to $150 a month. So that's crazy amount of expenses. And all of these subscriptions, they look small, but they all individually add up. That money, instead of investing in subscriptions, if you had invested in the stock market, that will allow you to retire maybe a couple of years earlier. A big house to live in. And this is where I say the house that you live in is not an asset, it's a liability. If you are buying because you're seeing all of your friends buy big houses, I think there is aspect of shortage in India. Some of the cities in India have shortages and the appreciation is really high. But even in those cities, if you save that money and rent instead and put all the savings in the stock market, your rate of return is going to be much higher. So buying a house to live in is not necessarily an investment for your future. It's I no doubt about it, makes you happy. It's a family where you live. You want to be in a nice house. You want to get a new patio deck. You want to sit in the backyard and sip chai, right? So it'll make you happy, but it's not necessarily making you closer towards retirement. So what I would recommend is rent a house close to your work. So save on the commute time, save on the expenses of commuting, and whatever the money that you save, try to invest that instead. Eating out. People spend a lot of money eating out every day. All of that money invested from Starbucks or going out to restaurants every day for lunch, dinner, etc. And I used to do that too, and I'm guilty of that too. All that money adds up, and before you know it, your savings go from 50% to 10% or 5% because there are all these other expenses that build up, and you cannot save as much as you want. So spend on meaningful experiences. So I said happiness is not bought by money. So, but you can do meaningful experiences for happiness. So we have all these examples of great examples. I just took a few pictures from our WhatsApp group of people spending time with their families. None of these things look like very expensive things to do. You're spending time with your family, you're enjoying your life, creating memories for the future, and increasing your happiness for you and your family. These are probably the better ways for you to spend your time. Don't spend your money, get meaningful experiences. Don't buy more objects to try to get happiness. So invest the milestones. Let's say every year you get like a bonus or a promotion or a gift from relatives or you get an inheritance from somebody. You have a lottery ticket. You won $10,000. What we typically tend to do, okay, we look at this money and say, okay, I didn't have this money before. Now I suddenly have this money. Now this money, I can go out and spend that money. Instead, if you go out and invest that money, you can get out of the rat race sooner. So don't let your lifestyle inflation, every year when you're getting more money, your lifestyle inflates higher and higher and higher, your expenses go higher and higher. Instead of having your expenses go higher and keeping you to the rat race, try to save that money instead, invest that money, try to get out of the rat race. Is that clear?
Yes. Yep.
Yes. Amit, one of the fears I have, and it's more because I feel conservatively like that, but investing in the market allows me to lose 40% during times like this. How do I think on that?
I have a slide later on to talk about that. So hold on to that question. So the first thing we need, that's a good segue to the next section, which is risk and asset allocation. So I think it was Anand who talked about it, but look at where he focused on. He focused on the return, and that is something that we cannot control. What we can control are on risk that we take in investment, the cost that we spend to get that investment, the amount of time that we invest the money, and the behavior. These are the things that are under our control. The thing on the right is not under our control. The return is not under control. So, however, what we rarely focus is on these things, but what we entirely focus is on the return. So, everybody who wants to invest asks, okay, which stock should I buy? Which industry should I buy? And not about the rest of the things, which are much more important. Asset allocation is way more important than what stock that you buy. So this was a survey question that I asked. What is the level of risk tolerance? There are some people who are very conservative. I guess Anant might fall in this role, where I prefer peace of mind over the risk of losing gains, over maximizing gains. And some people are moderate, where I don't mind taking some higher risk to get higher gains. And some people are aggressive. I don't mind short-term losses. So 40% losses that somebody mentioned, that can happen short-term, but I know that in the long term, the stock market always come back up. And because this money that I'm losing 40% on is not money that I want to withdraw next year. It's money that's 10 years, 20 years, 30 years from now. That's when I need it. And over that 30-year time period, it'll always go up. So we'll take a look at that further. Let's take a look at diversification and risk. Here's an exercise for you guys. There is an island. There are two companies, umbrella company and resort company. When there's the rainy season, there's a lot of demand for umbrellas, so that the return on that investment 50%. The resort, of course, nobody wants to go to resort when it's rainy. Their return is 25% decline. For sunny season, your umbrella company, nobody wants to buy an umbrella if it's sunny, but resort gets a lot of business. So in both these cases, you can see that the average return is 12.5%. So over the year, let's say one half of rainy or one half of sunny, you get 50%, 25% return for this. On an average, over a period of time, you get 12.5%. However, it's risky because sometimes you can get 50%, and sometimes you can get 25%. So there's a variance in returns, and the variance in returns is called the risk, where you're not controlling how much you're getting. So in both cases, the average is 12.5%, but the variance is high. But what happens, can somebody guess, if I choose 50% umbrella company and 50% resort company, what would be the average return if I had that investment?
I mean, if you're saying your allocation is 50-50?
25%.
Yeah, no, it should be 12.5 only. If your allocation is 50-50.
50% here, 50% here. What is your average return?
12.5.
12.5.
25%.
12.5% is the right answer. And the result is because now you're taking average here. You have 50% here, 50%. When you have 50% here, 25 minus 25% here, and you minus 25% here, you're 50% here. So on average, you still have 12.5%. And on the surface, it looks the same, right? What's the big deal? I was getting 12.5% here, and I'm getting 12.5% here. What big deal did I achieve? The most important thing is you reduce the variance. So your stock variance returns could go from minus 25%, 50% to a huge swing. And this is not under your control. But 12.5% is solid. 12.5%, you've taken away all the risk, and you're getting a 12.5% solid, whether it's rainy or sunny. It's not like when it's rainy season, I eat Maggi noodles, and when it's sunny season, I eat like a grand buffet. You're getting good returns on both sunny and rainy seasons. And this is because they are negatively correlated. Basically, when one goes up, the other goes down. That's when the correlation is supposed to be negative. And the goal of your portfolio should be to build a portfolio such that there is always a diversified level of risk. So if something goes high in your portfolio, something else goes low, and they balance out each other to give you a steady state of return without a lot of variance. So when you're building a portfolio, you have the risk of the portfolio. This chart shows the risk of the portfolio and the number of stocks in portfolio. And the two parts to risk. One part is your undiversifiable market risk. So there's a certain amount of risk that every stock in the market has, and that's called the market risk. You can add more stocks, but you cannot get rid of it. But there is certain amount of risk, which is the diversifiable risk, which you can get rid of by getting stocks which are not directly correlated to each other, which are negatively correlated. And the more stocks you add, the less your portfolio risk goes, until your ideal level of risk is the market risk. So there's a certain amount of risk that you have to take, and you're getting the market rate of return for taking that risk. So it might be a flashback to some of you from Ken's session. We have a market rate of return and your risk premium. So market risk is when you have a diversified portfolio and you're getting the average rate of return. And that's how we want to build a portfolio. And when you look at your portfolio, there are different kinds of assets that you can buy. You have cash, bonds, stocks. I know there are real estates and so on. I'm not going to go into this discussion, very short time period. Let's focus on 3 simple allocations: cash, bond, and stock. And as you can see, the lowest return is cash, but also the risk is low. And highest return is stock, but the risk is high. So you have a whole gamut of investments that you can make. And the goal is to create a portfolio that has a good return with a manageable risk. And the way to do that is to start out your life by being more aggressive. This chart on the left shows you, here's your retirement period. This is 0 years left to retirement. Here you have 40 years left to retirement, let's say. At that point, you are very high on stock and very small on fixed income. And as you get older, as you get closer to retirement, you decrease the amount of stocks and you increase the amount of fixed income. And once you go beyond retirement, you now start to save more cash equivalent. So money market, short-term, savings bank accounts, fixed deposits, you start to spend more of that. So this is how your asset allocation changes over your time period. It could be as you grow older or as you go closer to retirement. And what I have on the right side are 2 different profiles. I mentioned that some people of you are risk loving. So there's aggressive investors who don't mind take a little bit of extra risk. Some people are risk averse who are very conservative and don't want to lose money. So take an example of a risk loving investor. And it goes back to the example I think Anand mentioned. What if I lose 40%? This guy is going to say, I'm 30 years away from retirement. I don't really care because I know over the long period of time, stock market always going to come back up. I'm going to continue investing in stock. Whereas the risk averse investor will say, okay, I'm far from retirement, but I still want to minimize my risk. I'm going to only invest, let's say 80% in stock, 30 years away. 20 years away, this guy, the risk-loving investor, becomes a little bit more conservative, adds 10% bonds, still says 90% stock. The risk-averse investor goes 70-30, 70% stock, 30% bonds. So as you can see, as you get closer to retirement, the risk-averse investor gets more and more conservative until it goes to like a 50-50 portfolio, 50% stocks, 50% bonds. Whereas the risk-loving investor always has a little bit extra weighted on the equity portfolio. So he has 70-30. Portfolio, and at retirement is 70-30 or 60-40. Usually it tends to keep it at 60-40 for retirement. So this is how different people handle their risks. And risk aversion is basically nothing but, can you sleep at night? I have let's say I have 4 crores invested in the market, and if the market falls 40%, am I going to have sleepless nights the next few weeks, months until it recovers? If you are that sort of a person, then you should not be investing heavily in this in assets. You should be more conservative. Let's say some of you might are 10 years away from retirement, and if you're very conservative, maybe you should not be more than 60% stocks, 40% in bonds. That allows you to sleep at night. But if you are risk loving, which means you know in 10 years it'll come back, and I know for 40% it declined, but I can still recover, then you can keep investing in higher stocks. So all of this will show what was the behavior when COVID hit, and March 23rd or so, approximately, when the market was down 35% from the peak. What was the reaction? Were you sleepless at night? Were you thinking about, oh my God, what do I do? Should I withdraw all my money from the market? If that is the case, then you're a risk-averse investor, and try to be more investive conservative before this happens, so you don't get tempted when the market falls to go and withdraw all the money. The worst thing that you can do when the market falls is go and sell all your money and put it into cash, because at that point you're selling it at the lowest point and losing all the gains, and when the market comes back up, you lose most of it, most of the gains. So this shows you, as a person who loves risk or hates risk, how should you invest. So what to buy, when to buy. We talked about different portfolio allocations. We talked about 90-10, 80-20 allocation, stocks and fixed income. If you're talking about fixed income, unfortunately it varies in different countries. I know in the US, you have a good bond market, which is efficient, which is not as risky, but in India, it looks to me that the bond market is only slightly more than fixed income, like a FD in some banks. So this is something that varies across your region. So I don't have a lot of specific recommendations for you, but what you do need to do is to identify what percentage of your portfolio is fixed income, and you need to invest in the different kinds of things like high-grade corporate bonds, government bonds, CDs, FDs, money market accounts, savings account. These are the places where you are sure that you won't lose your investment, or if you lose it, the amount of risk is less compared to the equities. So here's an example of a bond market fund for the US. You have a total bond market index fund called BND. It's an ETF. So you could invest 20% of your money in that bond market index fund. And that basically follows Lehman Brothers aggregate bond index fund. It goes to government securities, high-grade corporate yield, muni bonds, a small amount of junk yield. So it is a variety, spread across a variety of things, not too risky, not too high returns as well. But on the equity side, what you need to do is, we talk about diversification. You need to hold a diversified basket of equities. You need to have across industries. You don't want to count on just the oil industry, which may go up or down, or tech industry, which may go up and down, or utilities. You need to hold it across industries, across geographies, whether it's India, US, Europe, emerging markets, and so on, at a very low cost. You don't want to spend a lot of money in transaction costs, brokerage costs, or churn. You don't want to have a lot of churn, which generate a lot of tax returns. A good way to do all of this is index funds for the 99% of the people. This is the best way to invest it. Before I go to the next level, any questions so far? No? So then I will continue. So when we talk about index funds, some people have a very good understanding of index funds. Some people don't really quite know how it works. So I'm going to make an attempt of a quick overview of what an index fund is. So how is an index fund constructed? Basically, you take all the stock market, stocks of the market. In S&P 500 fund, you take the top 500 capitalized stocks of the US stock market, and you take a market value weighted index. So you take Apple is 935 billion at that time, and it's 3.75% of the total stock market cap. So you invest 3.7% in Apple. Same, Amazon is 3.5%, Alphabet, Google is the 3.3%, and so on and so forth, until you have 500 different stocks. And each stock, the investment is up to the capital market capitalization of that stock. So how big, the bigger the company, the more the weightage of it in the stock market. So this S&P 500 fund now consists of 500 top funds, and it invests in all of them a small chunk of it. Is that clear about index funds?
Which S&P fund is this?
This is not related to any S&P 500 fund. It's just the S&P 500 index itself. What is the composition?
Oh, index. Got it. Okay.
Index. So 2018, what was the composition, and how, if you're invested in an S&P 500 fund, how would your money be invested? It would be like, let's say one third of it would be tech stocks, and let's say 10% in utilities, to 10% in energy, and so on.
Yeah.
So what makes index funds so great? One great advantage is a large diversification. You just make one investment and automatically you're diversified across many different sectors, many different geographies. You have low expenses. Index funds are among the lowest expense ratio funds that are available. They have high liquidity. there are a lot of people buying and selling index funds, so you can always get in and out of the market. So the spreads are very low. They're tax efficient. So since they are buy and hold, they don't trade very often and they don't generate a lot of distributions. So they're very tax efficient for you. And they're passively managed, not actively managed. And the reason why that's important is passively managed investments beat the vast majority of active fund investors or individual stock pickers. So you have a peace of mind. You set it and forget it. You invest in a diversified basket of stocks, and you don't have to worry about it. You can focus on what's important to you. You can focus on your career, get the next promotion, make more money, so you can have more money to invest. Rather than going out and spending your time in the market and thinking which stock should I buy, will it go up, will it go down, recovering during the crash time periods. All of that can be avoided by going by the index fund route. And it's not just me saying it in general. Since John Bogle of Vanguard came up with the idea of index funds in the 1970s, the industry has been moving gradually more and more towards indexing. So it's moving away from active flows to passive flows. So here, take a look at US equity fund flows. What's happening is this is the investments every year that are going into passive funds. And you can see the passive fund investment over the years are going up. And these are the investment going into active funds. For a while, active funds were doing well. And the amount of money that were going to active funds kept going down and down and down. What this means is for any given year, more money goes into index funds than active funds. Because people don't trust stock pickers because they have really struggled. Stock pickers have really struggled to beat a passive index fund.
Amit, what is the advantage of investing in ETF versus a fund?
So there's not too much advantage if you're a buy and hold investor for a long time. So
any tax advantages?
Where are you, in the US or in India?
In US.
In the US. So in the US, there is some advantage of holding ETFs over mutual funds, because mutual funds, whenever there are, let's say somebody is buying a lot of shares or selling a lot of shares, ETFs, what you have is you have a fixed amount of shares, and when people sell, you're buying it from other people rather than redeeming it from the mutual fund company. With the mutual fund, what's happening is when you're redeeming your shares, the mutual fund company needs to have a certain amount of cash available to make it available. So they have to go and sell shares in order for you to pay you. So that generates capital gains. So because that generates capital gains, you end up paying some taxes on it. And it's not always the case. Some mutual fund companies are very tax efficient, like Vanguard is a very tax efficient mutual fund company. So whether you're holding a Vanguard ETF or a mutual fund does not really matter. In some other cases, it does matter. So mutual funds, usually the other difference is the value of a mutual fund is calculated at the end of the business day. So if you want to go in the middle of the day and place an order on a mutual fund, you cannot buy it. They take your money, wait until the end of the day, calculate how much the net asset value is, and then you could invest. Whereas the ETF intraday, you can trade. You can look at the stock price of that ETF intraday, and you can buy at 9 a.m. or 2 p.m. and get the value at
during the market hours. Yeah, understood.
During the market hours, so it fluctuates. But if you're a buy and hold investor, it doesn't really matter. ETF versus mutual fund is essentially the same.
And the expense ratio would be a little bit lesser compared to funds, right?
Yes, expense ratio is a little bit lesser for ETFs compared to mutual funds. If you take a Vanguard, for example, let's take a Vanguard fund which has, let's say, 0.10% for the mutual fund version, may have 0.05% for the ETF, because the ETF has less work that they need to do.
Yeah, and there's no load fee and all that stuff.
Load fee. For people who don't know, load fee is basically some mutual funds charge you money to enter into it, so that's called an entry load. And some mutual funds charge you from leave the fund, called exit load. If there is any exit load or entry load, don't choose those funds. Always be careful of those. Always go for a very diversified equity fund with the lowest expense ratio, and which is typically index fund. Okay, we looked at index fund. I looked at S&P 500 index fund, but that's a US only stock market index fund. And you also have to consider geographical diversification, not only US, but Europe, emerging markets, developed markets, etc. So be aware of home country bias in a good way and a bad way. Home country bias means people who are in India tend to invest all of their money in India. People who are in the US tend to invest all of their money in the US. People who are in Europe tend to invest all of their money in Europe in euros. And to some extent that's justified because that's where you're living, that's where you'll be spending your money in. So you're eliminating some of the foreign exchange risk. If your currency falls very low or goes very high, you're not suffering too much in your retirement fund. But also on the other hand, you're not gaining the benefit of diversification if you invest only in your home country. Specifically for the people in India, the Indian stock market, believe it or not, is less than 3% of the world stock market capitalization. So if you're investing 100% of your stocks in India, then you're getting benefit of only 3% of your diversification. If you invest outside the world, you have the benefit of correlation. So let's say something happens in India. Let's say India had COVID cases, 2 million, but in let's say in some other country, they recover much faster. Their stock market goes up. So you're eliminating some of the local risks by diversifying across different geographies. And that leads to correlation, where typically US and international stocks are less correlated. Over time, they're getting more and more correlated, which means that when US stocks fall, typically the international stocks fall as well. But there's still eliminate a small amount of correlation gap between them. So it's still beneficial for you to invest in international funds beyond just your domestic funds. So important thing to when you're considering investing is where are you going to live? If you're going to live in the same country, tend to prefer more of your home country. If you're going to live abroad, a different place, try to get more exposure to foreign allocation as well. In any case, 20 to 40% of stocks allocation international is recommended for you, just so you're avoiding risk based on just one geography.
So Amit, this 20 to 40% in international allocation is pretty broad range. What is your recommendation?
My recommendation is 30%. That's so I'll give you what I've been using. So I'm about 35% international, 55% US for my own portfolio. So it depends on because I know that I'm going to be living outside the US. So I went from midpoint. I went a little bit towards the more international allocation because if I want to withdraw money in euros or Moroccan dirhams and so on, I don't want to count on the US dollar remaining high. If the US dollar falls, I want to make sure because I have investments in international funds, so those will rise when the US dollar falls. So at least I'm a little bit hedged that way. So for typical investor, I would say 30% would be fine. If you're never going to move outside of the country, 20% investment in international is fine.
Yeah, and international, it is emerging markets versus US. Like how much percentage do you prefer?
For that, what I recommend is not try to, so everything should be based on the market cap of what the emerging market cap is, what the developed market cap is, what the US market cap is, and should be proportion to that, in proportion to that. So whatever 30% decide, you would allocate along that proportion. And it's made easier because there are funds which automatically do that calculation for you and are available. And I'll cover a couple of them in a minute, which automatically allocated based on what the world market cap is.
Amit, one more question.
Yes.
So if you invest in like S&P, right, let's say,
yes.
So how much of an exposure to international do you get? Is that enough or it's not enough?
That's a very good question. Some people say that S&P 500 funds, the 60% of the revenue of the S&P 500 companies comes from outside the US. So this thing for US investors really is good enough. If you invest in S&P 500 fund or US total stock market fund, it's good enough because more than half of the revenue comes from outside of the US. I prefer though to be explicitly invest in international funds because when you're buying an S&P 500 fund, you may be getting Ford and GM, but you're not getting Toyota, for example, which is still a good company. You're not buying an SAP. You're only buying, let's say, Facebook and Google. You're not buying an SAP, which maybe is from a German company. So even though the S&P 500 has 60% from outside, I think it's still good to have 20% minimum allocation to international funds. And more so because over the last 20 years, the US stock market has done really, really well. If you compare it to international, it has done really good. The returns are much higher compared to international. But if you consider mean reversion is a thing, then maybe in the next 20 years, the international funds will do better than the US funds. We don't know. We don't know all the geopolitics that are going to take place, the increased amount of US dollars being printed, what is going to be the effect of all the stimulus. So it's best to be hedged across different markets, different geographies. And I have an example for somebody who's talked about the US fund. Here's an example. Putting it all together, we talked about different portfolio allocations. And I'm going to take one of those portfolio allocations, the 80-20, and see how you can split that 80-20. So if you're a US investor, let's say you've identified that you want to be 80-20 stocks and fixed income. And within the stocks, you want to be 70% domestic, 30% international. So how does it all come together? You take that 80% and 70 multiply that by 70%. So it's like 56% of your portfolio would be US total stock market index fund. So example, VTI, it's a ETF which invests in 3,000 top US stocks according to their market ratio. So you would invest on your portfolio, keep 56% US total stock index funds, and the 24%, which is 80%, 30% is 24%, would be all excluding US. So all world excluding US stock index fund. So basically they take entire world, the developing markets, emerging market, and all of it according to the ratio of its market cap. So if you invest in just these two funds, VTI and VXUS, is basically covering you US and international and emerging markets, everything. Does that answer the question that you had? How much to invest in emerging, how much to invest in developed world, etc.?
Yeah, thank you. So how often do you balance this, rebalance or whatever?
You rebalance it once a year. And I have a slide specifically on rebalance. We can discuss more about rebalancing at that time. So you rebalance once a year. And if there's a big market turmoil, maybe you rebalance more often. So that's quick preview. And 20%, if you have a 20% allocation bond index funds, you choose a bond index funds, a BND. So all these are three Vanguard ETFs. So with these three ETFs, with the three fund portfolio, US, outside US, and bonds, these three are the only investments that you need for a retirement. You don't need to go out and look for individual stocks or look for a lot of different things. Don't spend your time investing in getting too many things and getting it wrong, because 90% of people cannot beat an index fund. That's just over 1 or 2 year period. When you consider 10%, this goes to 95%. 99% of people cannot beat an index fund just because people don't have the discipline in sticking to an investment. They'll look at something going up, something going down. They will chase performance, and they will always end up being worse than index funds. So for an India investor, what does it mean? Let's take the same example, 80-20 stocks and fixed income, 70-30 domestic international. In your case, let's say you determine that I want to do 70-30 domestic international. I would personally would say, if you're in India, since your Indian stock market is so tiny, I would say go a little bit more than 70, go 60-40, 60% India, 40% international. So you're not just counting on one small piece of world economy, you're counting on all of the world's economy. But let's say you chose 70-30. So you'd go the same 80-70 route and you chose 56% Nifty 100 stocks. Now, there is not many funds which have Nifty 100. So there is one fund that I know of, Axis 100. And it has a 0.16 expense ratio. It's not a bad thing. So go with that if you can. Nifty 100 stock, which will take the top 100 market cap stocks in India and invest in all of them equally. Not equally, but according to their market cap. If you don't have access to Axis 100 fund, there are other funds available. So the Nifty 50 funds, which is the top 50 funds, and Nifty Next 50 funds. So you'd say take a 80-20, 80% Nifty 50 and 20% Next 50. You would invest in that ratio, and you would come up with the total 56% of a portfolio would be Nifty 100 fund. And for the 30% of the portfolio, you can Now, you guys don't need to worry too much about US and international. It's all one bucket for you. You can choose one fund which does the whole world. You can choose a fund called VWRA. It's a Vanguard Worldwide Accumulating Fund. So it's basically invest in US, developing, emerging markets, all different geographies in one fund, and it's accumulating. So all the distributions get added up. So you don't need to pay capital gains every year. So this is special for international investors. For US investors, you cannot do that. You cannot get access to this fund. It's available only for international investors. So you would invest in 24% in this. In 20%, you would do the best FD fixed instruments. You would have the government security bonds, or you would have fixed deposit instruments and so on. Questions about this?
Amit, if we invest in international funds, if we are staying in India investor,
Yes.
does it attract tax in India?
Yes, it does. I don't know the exact tax. Somebody in the call will tell you, but you are allowed to invest up to $250,000 per year. It's called liberalized remittance scheme, and the taxes will be similar to a debt bond fund. Same amount of tax on gains you'll be paying on debt bond fund.
Okay. Of course, for someone like me who have no knowledge of this, you can advise us how to do that. For example, in Indian market, we open a demat account. Is that sufficient for international investment, or how?
Yeah, you can open a demat account, and many banks offer it. ICICI Bank offers it, or there are international brokers like interactivebrokers.com offers it. So you can go and open an account there. There are know your customer requirements where you need to go and prove who you are. But once you've proved yourself, then you can transfer a certain amount of money to them, and then you can go and buy ETFs or foreign funds. Basically, you could go and buy this particular fund, VWRA, through that demat account or through interactive brokers. Another different option for you, if you don't want to do that, is there are some international index funds available in India. They're a little bit higher expense ratio, but maybe you're saving the cost of foreign exchange, sending foreign exchange to international broker to buy the fund. So, for example, Motilal Oswal 500 fund. So, in case you don't have access to anything, you can buy the Motilal Oswal 500 index fund in this amount, and that should give you exposure to the US market. But if you have an option that you can invest internationally, you can go out and buy these funds directly from brokers.
Yeah, okay, thank you.
I wanted to add one point to this, and this came from Debashish Bose's presentation. He said that during the course of the Indian stock market, although it has grown with time, that the dollar value of that has not grown with time. So by investing in the US market, you are protecting your currency depreciation. I think Amit.
Yes, that's absolutely correct. So because, I mean, when I left India, the INR was about 40 rupees to the dollar, and now it's 75. So just the fact of in a few years, the currency has fallen almost 50%. That means all the gain that you have is kind of a lost gain, because in terms of dollar parity, you're actually not gaining that much money. So if you invest internationally, so like I mentioned, if you take 60-40, then 60 domestic, 40% international, then if the rupee falls, you will get the benefit of that, because your international portfolio will go up in rupee terms. If the rupee gains, you still have your domestic portfolio, which will support you. So in either way, the main thing about retirement, main thing about financial investment is hedging your bets. You don't want to put all of your eggs in one basket. You want to make sure you're diversified across different geographies, different currencies, different markets, and so on.
Also, the inflation rate is pretty high, right, compared to the US in India.
Yeah. Inflation rate is so high, but that reflects itself in your rate of returns that you get. When you're considering FD in India, you get 4 to 8% FD in India these days. But in the US, if you try to go fixed deposit, you're lucky to get 1% fixed deposit. So all of that comes to your stability of your currency, how much inflation your economy has, and everything, and how much risk your national economy has. India is considered a little bit of risky economy, so that's why the interest rates in India are higher. the India has to pay more interest rate for people to buy government bonds compared to the US government, which is considered less risky. So people all over the world buy US bonds and are willing to accept a 0.25% yield for a US government bond. Any other questions?
So there is no gold in this all, right? So I think you don't.
I think gold requires a separate topic of its own. I will send you some pointers. Gold is a hedge against uncertainty, and you probably noticed now right now, gold is really shooting up. But if somebody wants to say, okay, now maybe gold is shooting up, let me go and buy now. It's a bad time to invest in gold because over 30, 50, 80-year periods, historically, gold significantly underperforms stock markets. So if you take a graph of gold performance, gold may go like this, stock market goes like this over long periods of time. Even despite stock market fall, despite the fact that during a crashes, gold shoots up like this, but it'll stagnate. If you invest in gold now, it's going to stagnate over the long period of time. And really, you're going to suffer later on. So what I recommend is, these are guidelines, but there are always people who say, okay, but I have a itch to scratch. I think I can do well in stocks. Can't I go out and buy Amazon or Facebook? Can't I go out and invest in gold? Can't I go out and buy Bitcoin? I would say be very cautious, be very careful, because this is the money that you want to retire on. This is your family depends on it. So don't go crazy in all of these alternative investments. If anything you have to do, keep all of those investments, 5 to 10% of your entire portfolio should be all those risk investments, individual stock, gold, cryptocurrencies. Cryptocurrencies stay the hell away from. Gold and the other thing you can, individual stocks you can do, but keep it to 5% of your portfolio. Don't go beyond more. Most likely you're not going to be very successful compared to index fund, but at least if you're not successful, you didn't get a big hit. But if you're wildly successful, maybe the 5% will juice up your retirement gains. So you are hedging your bets in that way. So my recommendation is no more than 5 to 10% in alternative investments. Try to stick to the main ones: equity, fixed income, and cash.
Amit, what about real estate in in terms of India or
so real estate? I mentioned in the past, if you're buying a house to live in, it's a bad investment because the appreciation rates don't help you. The stock market appreciation rate is always higher than the real estate market. Over the last 50 years, if we look at it, there may be a small blip of a few years here and there where real estate has done well, but over a long period of time, the stock market always does better. You take that down payment and you take that extra monthly payment and you invest it in the total stock market, you'll definitely do much better. Now, there's a difference between that and real estate for investment, rental properties. So like I mentioned, there's a cash flow fire. People invest in real estate properties. They put 20% down payment, buy a house and then rent it out. Take that cash flow, pay the mortgage loan, and then use extra cash flow to put a down payment on another house, buy that, and so on. They continue this, so on. And they do a successful thing at it. But personally, I don't like it because it's a lot of work for me. I'm a lazy person. I don't want to go after people whose toilets are broken at 12 p.m., 12 a.m. at midnight, and I have to go out and go and fix it, or I have to call my handyman to go and fix it. I do own 2 properties. I do own one in Portugal, one in New Jersey, but it's not my favorite part of my job. But people do that. People who do this typically hire property managers. They have handymen, and they try to make it so that it all runs by itself. And as long as you're getting greater than 6% return annually over your investments, it's fine. It's certainly, if somebody's hands-on, somebody's active, if you want to do a lot on the side, you can do it. Just be careful that there is risk in it. Real estate is not just because you have this asset, it's not risk-free. Look at the market crash during the 2008, 2009, the housing bubble. When in a particular area, the housing bubble goes so high, the house prices fall, the banks start foreclosing on your loans, you cannot make payments. Because of COVID, your tenants say, oh, can you give me a discount? Or I say, I cannot pay rent. and the government says, no, you cannot foreclose, you cannot kick out the tenants. Now, suddenly your cash flow is drastically reduced. You have a lot of mortgages to pay, and you're very quickly upside down. You have a big loans to pay, but your income to pay that is very low. So be careful that you don't get into this trap of being an upside down debt when things crash. But in general, if you're conservative, if you're looking at very undervalued properties and properties which can get good rental yield, this might be a good investment for some people to do it as a side hustle.
To ask a question back on that, what is a historical rate of return for US houses and India houses?
Yeah, I don't know about India houses. I was just looking the other day, historic over 50 to 80 year period, the returns on US houses were barely above inflation. So I was looking at the numbers, there's 5%, 5.4% return on investing in real estate. And the inflation rate during that period was 4%. So basically making 1.4% more than inflation, which to me is not very exciting investment.
But
the stock market is much higher than inflation.
Is that only looking at the appreciation, or does it also account for cash flows and other things?
It is looking at appreciation, just the real estate appreciation. So with cash flow, you might be able to get that number higher. So instead of 5.4%, you might be, because you're recurring cash flows and you're buying new properties, you might be able to go higher. But by itself, rental property price increases maybe 5 average at the rate of inflation, about maximum 1% more than inflation over a long period of time. So don't count on your $1 million house to be worth $2 million when you retire. So don't try to invest that much money in your own house.
It's just for your pursuit of happiness. That's it.
You have to, if you're buying a house, you have to know upfront. I know this is a bad investment, but this is for my peace of mind. It's for me and my family to live in. I'm happy with lower rate of return. And if you're okay with that, go ahead. But if you want to retire early, try not to buy a mansion, try to buy a property that you can afford, or if you can, try to rent property and the difference, invest it in the stock market. You'll come out ahead.
So in my research, Amit, I think probably we can take it offline. In my research, in US, there are lots of benefits for real estate investors. That's one. And I agree with you. The primary home that you live in, it's mainly for the quality of life rather than, we should not look at it as an asset.
Yeah, agreed. The primary home, the case for primary home in the US has gone even worse because with the recent Tax Cut Jobs Act that Trump did about a couple of years ago, the standard deduction for everybody is increased to $12,000. So for a family of 2, you have $24,000 deduction automatically without even mortgage interest. So for many people, the mortgage interest is completely worthless. People bought bigger houses thinking they'll get a bigger mortgage deduction and that'll help them. But even a person who doesn't have a house can get the same 24,000 deduction as a person who owns a house. So the owning your own personal house has become significantly less important. But however, if you have a rental property, then that mortgage interest can be deducted against your rental incomes, and some of that can also be deducted against your other income. So if you own a rental property, it's still beneficial. But if you own your own house, it becomes significantly less beneficial these days to own a house. Okay.
Just one quick question.
Yes.
In terms of international exposure, you talked about index funds. Do bonds also make sense?
There are bond index funds as well.
But in terms of exposure, do they make sense, or is it just the stock index fund is good enough?
So you mean should I have a bond international fund or not?
Yeah.
I don't think it makes that much of a sense. So the diversification of international bonds is not that beneficial. And I hesitate to mention too much about bonds because in these, these low interest rate periods these days, bonds are now so expensive that are yielding very little these days. And bonds across the EU zone are even worse. They're negative yielding bonds. So people are just buying them because hopefully somebody else will buy them at a significant expense. So if you're a US investor, I would say stick to US bonds. That's good enough. You don't need international bond exposure.
Okay. Yep. Thanks.
Okay. coming up to 1.5 hour mark. I should probably speed up a little bit here. So when to buy? This is a good question that people ask. So when do I buy? The stock market is at all-time high right now. If I buy it right now, will it crash tomorrow? I think you should never try to make decisions based on what to buy, based on what the market is doing. Always invest in the market whenever you have funds available, and set it and forget it for the long term. Over the long term period, you will always come up ahead. Even if the stock market after you invest crashes 40% tomorrow, over the next 10 years, 20 years, 30 years, it will recover. So don't worry too much about it. So one way to avoid it is cost averaging, and people might be familiar with this. People say, if you have, let's say, $100,000, don't put $100,000 in the market at once. Put it in every month, put $2,000 at a time until you have the whole 100,000 invested. And the thinking behind that is you're investing fixed amounts of money at a time, and you have dollar cost averaging or rupee cost averaging, which means when the market is high, that amount is buying less shares, and when the market is low, that amount is buying more shares. So on an average, your cost per share goes down. So it's beneficial to do cost averaging. But there's some studies which show that if you have $100,000, and you're keeping that $98,000 in cash and putting to $2,000 per month, it's probably overall you would come up ahead if you invest lump sum. So whatever money you have for investment, put it in the market right now, and don't try to cost average it. Over the long period of time, if your retirement period is 20 years or more, you will come out ahead by doing lump sum rather than cost averaging. Any new money, however, should be invested as soon as you have it. So let's say we talked about, let's say somebody is investing 30% of their income. Every month they want to invest 30%. So you have a salary coming in, 30% of the money goes to your brokerage account, automatically buys the index fund. Continue that on a regular basis, day in, day out. Don't worry about how the market is doing. Invest a fixed amount of money as soon as it's available, regardless of what the market is doing. The reason, regardless of what the market is doing, is because we have a over-exaggerated sense of our own ability to perceive things. So here in this example, you look at a cycle and say, oh, things can only get better. I see that things are going better. Let me buy more and more and more of this stock which has gone up. Let me buy more gold, because gold has gone up so far, it's going to go up more. So what this happens is typically just before a crash, people end up buying more, and then they will notice a big drop. So they'll notice a big drop, and then they'll say, oh, it's going down, 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 down. Maybe I should sell it all. When things are going worse, people think it's only going to get worse, and they will sell it. And when things are getting better, people will think it's getting better and buy more. So don't make the decision based on what the market is doing. Keep the market gyrations outside of the decision. The most important thing you do is identify your asset allocation, and based on that asset allocation, keep steady your investment. So when to sell? So that leads to the interesting question. You're saying, okay, buy and hold. Does that mean I should never sell? So you should never sell based on the current market conditions. You should never sell because the COVID is killing the market, 35% down. Oh my God, let me sell my stocks and go into gold because gold seems to be stable now. You're doing it the worst time possible. You're moving from the asset which is low to asset which is high. And because of mistakes like this, people delay the retirement by 5, 10, 20 years by doing that. So the only time that you should sell is when you're changing your asset allocation. What does that mean? Let's say you're moving closer to retirement. Before you were 30 years away from retirement and you had 80-20 stock allocation. Let's say now you're 10 years closer to retirement. Now you need to move 70-30. So at that point, you sell 10% of your stocks and buy 10% of bonds. That's when you sell stocks, buy bonds. To rebalance, somebody asked, how often do you rebalance? Once or twice a year is good enough. You also rebalance when the market goes down. I will cover that in a second. So living expenses. So when do how do I get my money to survive? If I said don't sell stock like the market is doing, your living expenses should always come from the fixed income part of your portfolio. And that's why as you go closer to retirement, you're getting more and more bonds, more and more fixed deposits, so on. So when there's a market crash, you can withdraw from your fixed deposit without affecting your the stocks, without selling your stocks at the worst time possible. So living expenses are again a time when you sell some part of your fixed deposits, and then you again rebalance your portfolio. You sell some stocks to buy bonds if it makes sense. So always buy and hold for the long term. So what to do during market crash? I think Anant asked. So yeah, go ahead.
I have a question. So what I understood here is that as you are approaching towards the retirement, recommendation is go to the safer investments. But so reduce your stocks, go to the bonds kind of stuff. But in the previous slide, you mentioned that for the longer retirement, it is better to be invested in the stocks.
Yes.
So is that the inflection point is right at the retirement? You basically switch the gear.
Yes, and there's a wrinkle to that. Hold on to that. That's a very good question. Hold on to that. I will cover something called the sequence of returns risk, and that will make clear this transition from stocks to bonds to stocks. It'll become a little bit more clear. So hold on to that question.
Okay.
So what to do during the stock market crash? So everybody, there's always, if you read your financial news or you look at your TV, there's always a reason to sell. The market is always in a panic. You have this is March 2009 worst depression time period, financial stock market, 663K jobs lost. Chrysler General Motor files for bankruptcy. Then BP oil spill, your flash crash. The Dow is breaking. Again, gold went really high. U.S. government shut down. Ebola came up. And what you can see during this time period, throughout all of these the really difficult things, the stock market always keeps going up over the long period of time. Over the short period of time, you can look at this. The U.S. government trade war happens. The S&P 500 enters bear market. So things will always fall down during the short period of time. But if you have a long-term horizon, the stock markets always come up high. So if you look at this time period, from 2009 to 2019, this 10-year period, the market went 495%. But if you look at the stock market, if you sold every time you had a bad news and you sold, then you would really put your own retirement back. So even though at this point, when you're looking at here, you don't have the benefit of future side. You look at only benefit of hindsight. It looks like, oh my God, the stock fell down a lot. Maybe I should sell. But it always recovers. When the time frame is long enough, the market always recovers. It is the key takeaway. And this does not, just looking at 10-year time period, but if you look at a longer time period, 20, 30, 40-year periods, you will notice this case. After every crash, there's 1 or 2 years of downtime, but then the market recovers. So if you're close to retirement, that's why the discussion goes back to your money that you're withdrawing should be from the fixed part of your portfolio, not from the stocks. So let the stocks continue to grow, give them room to breathe, let them recover and withdraw from your bonds. And if there's an extended period of stock market decline, that's why you need, when you're retirement, you need to have a higher amount of bonds. So,
Amit,
so use,
go ahead.
Go ahead.
Sorry, was it graph for S&P?
I'm sorry?
Was it graph for S&P 500?
I believe, yes, this is S&P 500 total return, which includes S&P 500 plus dividends reinvested. So if you look at the normal S&P 500 will not go so high, but the reason this one goes 495% is all the dividends have been reinvested in it. So every time you get a dividend, it goes and buys more S&P 500 stocks.
That's like 17% annualized returns, man.
Yeah, the US market has done really well over the last few years.
And you add dollars and
that dollar stability is a big deal.
The dollar has been going up the last few years, but there's some pressure on the dollar right now. It might go a little bit lower.
I think, Praveen, this range is also from best to worst. Like March 2009 was probably the worst.
The worst to best.
No, that's true. Similar thing was there. If you look at India, March 8, in fact, December 8, October, November, December 08, from that was the lowest point of Nifty, and today now, I don't think it will go to this place. This is about annualized 13.5. I think if you're entered in the lowest phase of Nifty and you exited it at highest point, it possibly is 13.5 or 14 at max. So US has been better than most
so
of the
US has done really good. Let's say 10, 15, 17%, sometimes 21% goes up here. But don't count on that. On average, count say 6 to 7% after inflation is what you should count on for your retirement. That's why we built our withdrawal rates to be 4% to be conservative, not count on 17% growth of money. So it's always good if it goes 17%. Of course, you'll have a very comfortable retirement. But if it doesn't, at least you'll have still have a very safe retirement. Okay.
So Amit, sorry, on the previous slide, I have a question.
Yes.
So basically, what happens is I hear two things. One is we just said that if you have money, then just invest. Don't wait for dollar cost averaging and things like that.
Yes. Yes.
But from very smart, from people around, I often hear one more general advice that, especially in today's time in US market, that there'll be buying opportunity, hold your cash, and then wait for that buying opportunity. So how do you balance?
So that's a good point. I've always heard that. So since 2009 to 2019. I've always said every time people say it's going to fall, just wait, hold on to your cash. And people predicted stock market crash in 2014, 2015, 2016. Every year they predicted stock market crash and they kept holding on to the money. And for some people it was so late that they were like 5-6 years behind, waiting for the market to crash and invest. So in general, time in the market is better than timing the market. So I'll repeat that. Time in the market is better than timing the market, because nobody can time the market correctly. So I don't believe the ability of some people to do better. I would say any money that you have, invest it right away. And I'll send you some studies. Maybe I don't have time to go over this right now. I'm already more than an hour and a half into it. I'll send you some study which shows the difference between lump sum investing and dollar cost averaging. It shows that over time, lump sum investing comes out ahead over dollar cost averaging.
Okay.
And Saini, I had a good friend who held on to the cash since 2015, and he was a very disciplined investor, a Buffett follower, and he's still holding on to his cash. 4 or 5 years of lost growth.
4 or 5 years lost. Imagine if money had grown 17%, he might have doubled his money by now. And he lost all that money by trying to predict the market. One thing that we have to get into our mind is we're not good at predicting what the stock market is going to do. The stock market is a random walk. Nobody can predict what the performance 1 year from now is going to be. But over the 10 years, 30 years, surprisingly, it's easy to predict that over the 30-year period, it will go up. Over the 1 year period, 2 year period, 3 period, not so much. Nobody is good at it. And that's why index funds keep beating individual investors and keep beating active fund investors. Okay, so what to do? Another question?
No, good. Thanks.
One question is, within the stock portfolio, how do you use the sector-based ETFs? Do you want to use those or just stick with index like QQQ?
Stick with index funds. Like I mentioned, if you have some hot knowledge that you have what some particular sector is going to do well. I remember the budget I gave you 5 to 10% of your portfolio. Feel free to play with that in that sector ETF with that. But in general, for the majority of investors, it's not necessary. You don't need to go into sector ETFs. You don't need to go into emerging market. Don't need to go into special things. A three fund portfolio is way more than enough for you to have a comfortable retirement. Don't risk it by trying to be too overachieving. That's my suggestion. And I'm going to caveat that by saying this is investment for the 99%. So there's always that 1% of the people who will turn out to be lucky. I'm not. I have an MBA in finance. I don't consider myself as one of those people. So I'm going to keep my money in index funds and bond funds, and I'm not going to go out tech funds or energy funds and so on. So I personally believe that they add limited value to your portfolio.
Hi Amit, how about this PMS, portfolio management services? Are they really worth it?
Okay. There's so many very interesting topics to cover in this area. apologies to anybody who is a financial advisor in our group, but usually the financial incentives of a financial advisor are not tied to yours. So you basically they make recommendations based on what is good for them, and second, what's good for you. So if you consider this very simple approach, a three-fund approach, US, international, and bonds, then you don't need a financial advisor for determining which funds to invest in. Now, financial advisor is absolutely important for different reasons. What are the reasons? How do I set aside money for my goals? I have children's education coming up. I have a daughter's marriage coming up. I have the house buying coming up. How do I structure my money? Where do I put money because that I need in 3 years? Where do I put money in 10 years, 20 years? How do I do it? Very good. Tax, what are the tax implications of doing this versus that? Financial advice is very good. Which stock to buy? Very bad. Don't count on personal fund managers to tell you what to buy. They will always do it for you, but at a very high rate expense. So managers usually charge 1% to 2% of your net portfolio value to charge money. And that's egregious amount of money. That's a difference of maybe 30-40% of your final money is going away because you're losing 1 to 2% of gain. If you're talking about a 5% gain that you want to get, and you're giving away 1 to 2% of it to your financial manager, believe me, your retirement is going to be pushed out by 5 to 10 years. So I would say, if you follow a simple approach, you don't need a financial advisor to tell you which stocks to buy. You need a financial advisor to tell you how to do tax management, how to save for your short-term goals, how to get a loan, how to do all those things. All those things, a financial advisor good for you. Another thing financial advisor good for you is to hold your hand. So people are conservative. When the market crashes, if nobody's there to advise them, they would go and panic and sell all their stock. That's when a good financial advisor comes in and says, no, this is a short-term thing. Don't sell your stocks. It'll come back. Be patient. That's where the financial advisor is there to hold your hands, answer your questions, reassure you, confirm your things. That's where the financial advisor is good at. I don't think a financial advisor is good at other places. Here's a specific example of what a financial advisor will try to tell you. They will try to tell you, buy this life insurance product. Life insurance is very good. And here's this insurance product which combines the benefit of life insurance and investment. After 20 years, you get X amount of gains and so on. The rule of thumb is life insurance is very important, but a term life insurance, basically a death benefit. When you die, let's say you have your policy for 30 years, you're 40 now, your policy for 25 years. Within 25 years to die, let's say it has a $500,000 policy for your family. That's very good, and that's important for a spouse to have such a insurance in case something happens to you, your family is taken care of. But life insurance policy should be very cheap. It's a term life insurance policy. When you combine term life insurance with investment, it's almost always a bad idea. Whole life insurance policies are a bad idea, and they're outrageously expensive. The first year, 3 to 4% of the money goes to who, not to you. It goes to the financial advisor who recommended that. So if you buy a policy, 4% of the money might go to him as commissions. So be very careful on whether your broker or if advisor has a financial fiduciary responsibility to you. Only work with a fixed fee financial advisor, not somebody who gets a commission on the stocks he trades for you. So that's a very quick overview into this very interesting topic. In the interest of time, I will move forward, but did that answer your question?
Hey, Amit, I have a quick question. What about a youngster just beginning his professional career? Should they be buying term insurance early on, or is there any thumb rule?
So a youngster just graduated. So term insurance is bought if you have dependents who are depending on you. Your family, your kids, and your financial portfolio is not big enough to support them if you die. That's when you need term insurance. Youngsters just graduating from school does not have any dependents. So there's no debt benefit. I mean, he can give that money to his parents, but the parents typically don't need that. So I think the best time to buy life insurance is when you have got your job, you got married, or you have a new kid that's coming in the way, and you're still young. That's when you need to buy insurance. So 30, 35, 40, 45, that's when you need to buy insurance, and buy it earlier rather than later, so your premiums are lower. As you get older and older, your premiums get higher.
Yeah, that was my point. So if it's cheaper to buy it earlier, so let's say you're at 25 or so, 25, 27, and you still don't have a family, is it worth buying it earlier?
No, I don't think so, because you'll be paying premiums for, yes, it'll be cheaper, but it's not necessary, because instead of insuring for 25 years, now you're insuring for 50 years, because your time period has gone up and your payments are going to go up. Your payments are going to be low to start with, but they're going to be a lot more. So you only need think about what role insurance plays in your life. Insurance is only if you have dependents and beneficiaries. You need a term insurance to take care of them, and that's it. Insurance is not an investment vehicle.
Great point.
Okay,
thank you.
Okay, moving on. So when you have a stock market correction, when you have crash, what do? Rebalance your portfolio. And here's an example. Let's say you're doing a 80%, 20% fixed income. And because of a crash, your stocks fall down. Now your portfolio changes to 30% stock, 30%, 70% stock, 30% fixed income, because the stock percentage goes down. That's the point when you rebalance your portfolio and you rebalance back to 80-20. So what you're doing at this point, you're selling your expensive bonds which have gone up. You're selling some of those, and the stocks which have gone down, you're buying some of those. That's the only correction you should make during a stock market meltdown. Don't try to go and change your asset allocation to be more bonds, less portfolios, just because the stock might go down. But use rebalancing to adjust it, and that way you're buying things which are fallen down. So after recovery, you'll notice that because you had extra stock, now the stock has gone to 85%, and your fixed income come down 15%. So that's when you rebalance again, because now you're overweighted on stock and you're underweighted on fixed income. So you rebalance again to 80-20. Over time, this will help you take advantage of market downturns, and your portfolio will be juiced up without trying to time the market too much. And don't do this very often, because if you're doing this very often, you're just timing the market. Once or twice a year, once or twice is more than enough. I think this was a question somebody had about rebalancing earlier. Okay, let me do a quick time check. How are we on time? I might skip this next topic and go to the following one.
We are way over time already.
Way over time, so I'm going to skip the sequence of events.
I think people are glued in, and there's a lot of engagement, so I'll leave the judgment to you.
Okay.
Amit, I think check your time budget. If you have other commitments, you can shorten it.
That's more the factor to play with rather than the audience system.
So I'm fine. So I'll go very quickly over this example. People who don't understand this can, of course, talk to me again later offline. So remember we talked about failure of retirement cases. So some 95% cases, 85% cases. Where does it fail? If as soon as you're retired, if you have a series of bad returns, that's when your retirement is a little bit of risk. So imagine you are retired now. Very simple example. You have $1 million of portfolio with 200K withdrawal at the end of year one. So this is a very simple example just to illustrate the point. So case one, year one, you have 100% growth. Year two, 50% decline. So one example. Average return, of course, is 25% arithmetic and 0% geometric. So it goes down, so 1 million goes down to 500 and then comes back up to, goes to 2 million and comes back to 1 million. There's no difference. And case two, you have minus 50% in the first year and plus 100% next year. So typically it's supposed to go down to 500,000 and come back to 1 million. It's supposed to be the same, equal, but there's a big difference. Because you have a 200K withdrawal, can somebody guess what happens when end of year two in case one? What is your portfolio, retirement portfolio? You have 1 million portfolio and you're withdrawing 200K. And you have 100% growth the first year and minus 50% the next year. What is your portfolio?
This is 800K?
900K.
Good, 900K, very good. So the quick math is from 1 million, it goes to 2 million. You withdraw 200K, it goes to, and then it goes to 1.8 million, and there's a 50% decline, you go to 900K. So your portfolio in case one went from 1 million to 900K. What happens in case two? It should be essentially the same, minus 50%, then plus
600.
600.
Yep. So see the huge difference. There's almost like a 50 to 33% gap between those two cases, only because the bad cases happen at the beginning and the good cases happen at the end. And that's one of the risks, is that a bad sequence of returns early in your retirement could decimate your retirement portfolio. And that's why you need to be a little bit more careful. So what does that mean is this. So as you get older, so you're age 25, you go to 65, and then your portfolio goes up high, you keep accumulating, and then you're spending money and goes down, ultimately it goes down to zero as you're 95 to finish everything. The most risky period for retirement is just the time when you retire, a little bit before and a little bit after. So the little bit before is the retirement date risk. So if the stock market falls, your retirement date gets pushed. And a little bit after is if your sequence of returns risk. If you like what we talked about, there's a difference of a 900K versus 600K based on what order the gains came in. So this is something that you have to pay close attention to. As you go closer to retirement, that's when you typically need to be more careful. And one way to address this is to adjusting your portfolio allocation. Before we mentioned, as you go closer to retirement, reduce your equities and then increase bonds over a period of time. And that's what this says. So as you get closer to retirement, you do a big jump into the equity side to make sure that your retirement is stable. The first few years are stable, so you don't have that sequence of return risk. And afterwards, raise the equity back. So what this does is it reduces equity at the point of retirement and then gradually increases it back to a certain fixed amount after retirement, after a few years, when your retirement sequence of returns risk is low. Because if the first 5-10 years you pass and there's been no big risk, then the rest of your retirement will go fine. Don't worry about it. And then you can go back up on the equity portfolio. The converse way of looking at that is to look at the way your bonds increase. So this is your bond exposure. As your time to retirement shortens, you increase your bond exposure. Just before retirement, you raise it drastically, and then you bring it back down. And during this time period, if you have a bad sequence of returns, bad years of the stock market returns, your higher percentage of bonds will help you recover from those. And once the risk period has gone down, you again reduce your bond and increase your stock market allocation more. So you're keeping pace with the 30, 40, 50 years retirement period. So this is how it's a little bit of interesting way how your portfolio allocations changes as you get older and as you get close to retirement. Questions?
Amit, I didn't really get this because you're supposed to be withdrawing from your fixed, like from bonds, etc. So why this thing that you're suggesting? I didn't really get it.
So the risk is, let's say you have a certain amount of bond portfolio at retirement. Let's say the stock market return has been so bad that your bond market got used up. Bond portfolio got used up.
Okay,
now you have to go and sell stocks. And now it's a really bad time to sell stocks because this time, unless you have a market crash, then you will be selling stocks for the worst time and you're not letting it go for a long period of time.
Okay, yeah, got it. Yes.
So this is giving you a little bit of more buffer room. So when you sell from your fixed investments, it doesn't go down too much and your stocks will still have room to grow afterwards. Okay.
Yep,
Any other questions?
Thanks.
Okay, so I will move quickly in the next couple of slides. We talked about a lot of things. We talked about saving money, identifying your target, identifying your expenses that you have, and determining where to live. So where to live is an important role to play because you might be living in a high cost of living. Let's say somebody living in Silicon Valley, where the house prices are crazy expensive. I mean, you need to have $600,000, $700,000, $800,000 house just to have a normal living, or you need to pay a very high rent your food expenses are high, your tuition fees are high, everything is high. But as soon as you hit financial independence level, you look at your expense and go, my California expense means I need to save $2 million for retirement. But if I take the same money and instead of 80,000 expense, I have a 40,000 expense, I go live in Texas or I live in Florida, I can use that same half of the amount. So you would use geographical arbitrage to make your retirement dollars go further. Same thing if you're living in an expensive city like Bangalore, maybe you want to go to Mysore, Mangalore, and other places, you can reduce your amount of money that you need by using geographic arbitrage. And there are many beautiful places in the world which are low cost of living. There are places in many places in India, there are places in Southeast Asia like Thailand, Indonesia, Vietnam. There are places in Europe, there's a low cost of place living like Portugal. In Morocco is a great one. In the US, within the US, you have a lot of places you can move to. There are tier 2 cities where the cost of living is low, but the standard of living is very high. Central America, Panama is a great place for US retirees to go to. The cost of living is maybe 60 to 70% of what the US is. If you go to South America, it's even further down, maybe 50%. So you can see how you can use geographical arbitrage to make your money go further and maybe enjoy your life and get exposure to new life, new culture, new areas. So I asked the question, would you be willing to move from your current location of retirement? So about 30% said, no, I like the city I'm in because I have my friends, I have my family, I love the work, I cannot get a job elsewhere. I want to stay here, this is where I want to live. 28% says, I will move, but I'm in India, I want to stay in India, or I'm in the US, I want to stay in the US because my children are US citizens, I don't think they can adjust to Indian culture, so that's a small amount. And this 41% surprisingly are flexible. If it makes sense, if my money makes sense, if it's a better standard of living, I'm willing to go elsewhere. I'm willing to go to Portugal. I'm willing to go live in Thailand. I'm going to live in Vietnam. This is flexible. So this is something I encourage you, all of you, to look maybe 3, 4, 5 years before you make that choice. Identify where the place you're going to go after your kids have left the house. Where do you want to go and live in? So something interesting to you. Yeah.
Hey, Amit, Subhash here. What's the story with Indians settling abroad, let's say in Portugal as retirees? I know the Brits do it a lot. They settle in Spain.
Yes.
What do you think of Indians in, let's say you talked about Portugal, what do you call cities?
Golden visa. Yes. So
no, not the visa. I'm talking about what's the like. It's not the visa. It's not about the how part. It's about, are there a lot of Indians living retired in Portugal, for example?
Yes. There's a Portugal. Ever since they started the Golden Visa, they have a big contingent of Chinese, Brazilians, Indians, Russian people. All of them looking to go to a European country, and Portugal is one of the easiest countries to get into, and that's why a lot of people are interested in that. And the reason is because first, the cost of living is not very high. It's surprisingly cheap. If you're outside Lisbon, outside Porto, Portugal cost of living is really cheap. It has access to good healthcare, most of the good infrastructure of Europe, and you have freedom to live, travel anywhere in the Europe. So after 5 years of Portugal residency, you can apply for a Portugal passport. And after that, you have an EU passport. And with an EU passport, think about it. If your children need to go to a school in EU or need to get a job, it makes it so much easier for your family to have ability to go to Germany or France or Spain. From India, somebody you go there is much more difficult to get a job. But from Portugal, your kids can go to a country like Germany much more easy to get a job. So that's why it makes sense.
So where do Indians go normally? I mean, in Portugal, for example?
So until now, people have been going to Lisbon and Porto. These are the places which are the most popular, very metropolitan, beautiful places. But the real estate prices are getting higher. The cost of living is going higher. But there are plenty of other places you can go in Portugal. We can discuss offline, perhaps.
Of course. No problem. Yeah.
Because I've been to a number of places in Portugal. Portugal is a beautiful country. A lot of great sea resorts, beaches, good seafood, very good environment, low traffic, etc. So there are good things.
All right. Awesome.
So quick look at where people have expressed interest in going: Bangalore, Mysore, Pune, people in say, India in general. These are the top choices. And then we have people who want to go to Spain, Valencia or Portugal, Washington DC, Costa Rica, Cochin, India, and somebody who wants to spend part of the time. This is the kind of retirement I like, where you go to places which are good during that season, and then you move. You have a nomadic lifestyle. You live in different places and take advantage of all the different beautiful things that those different places have to offer. And it's easier. The younger you are, much easier to have this lifestyle. The sooner you get to the early retirement. So my last slide, let's review some concepts. The first thing you need to do is calculate your target, estimate your expenses, and then come up with the target goal. For example, 25 times the expenses or 33 times the expenses. Save as much as possible, as early as possible. If you're currently saving 10%, can you save 20%? You're saving 30%, can you go 40? You're doing 40, can you do 50? If you have a dual income family, can you live on one person's salary and save 100% of invest 100% of the other person's income? That will get you 10 years closer to retirement than if you continue in your current path. Then asset allocation, choose an appropriate asset allocation for your life stage. The closer you are to retirement, get more conservative. The further you are from retirement, be more aggressive. So for example, people at our age, 80-20 is a good rule of thumb for people at our age. Invest in index funds. Don't try to go too fancy. Don't try to time the market. Don't try to pick individual stocks. Buy and hold for the long term. And in 10 years, in 20 years, this will give you good returns. So you don't have to worry too much about it. And finally, once you're in retirement, be flexible. Keep an eye on sequence of returns. As soon as you retire, if the market crashes, be conservative, spend less, because the early years of retirement are most crucial. And if you can get through the first 5 to 10 years of retirement and you're successfully past that, the next 30, 40 years are going to be a breeze. So don't worry too much about the first 5 to 10 years of retirement. Be very careful about money. Many people use side hustles. People use rental property markets. People have blogs. People do consulting. You don't need to do a full-time job. You can do a part-time job, 1 or 2 days a week, or maybe 4 hours a week to supplement your income. And that's good enough. It will keep you engaged. It will give you something to do during retirement, and also at the same time, it will make sure that you don't have a loss of money or risk of failure. And lastly, use geo arbitrage. Earn in a high cost of living place and move to a low cost of living place to make your money go further. And you're going to love to live there. Try to do your research ahead of time where you want to go. So that's my last slide. Any questions over any of these things?
Hey, Amit, one question. Regarding cash that you have in your savings account, I hear multiple, the range of advice, basically starting from you need to have at least a month expenses worth in your savings account worth 2 years. So how much, what is your recommendation there?
My recommendation is 6 months. Before you even invest in bonds or stocks or other things, you need to have a 6-month emergency expenses in your savings account. And for that 6-month savings, you don't need to do the maximum expenses. Do the bare minimum expenses: your rent, your food, your school tuition for your kids. If you lose your job, while you're looking for a job in the next 6 months, what do I need to support my family? Take 6 months of living expenses. Always keep 6 months of living expenses. Only then start investing.
Okay, great, thanks. And one more question, that bond trend you showed.
Yes.
So basically rebalancing just before your retirement, basically that means you're selling stocks and buying bonds. Doesn't that trigger some tax events? Before your retirement,
good question. So one thing is to do this gradually. You don't need to do a lump sum. You can raise it gradually. As you can see, it's not a step function. It's a It's not a step function. It's a gradual increase. Even just before the retirement period. So what it means is the last few years of your retirement, you could, from the money that you're coming, you could put more in bonds and less in stocks. So that we don't trigger capital gains taxes when you sell your investments. The other thing to do is, remember, you have tax deferred assets. So if you're in the US, you have 401k or Roth IRA. These are things where you're not taxed. So you can sell your stocks in your portfolio and move to bonds without incurring capital gains tax. So you can do that inside your tax deferred accounts and not have a tax hit.
Thanks, Amit. Great.
The last slide, the handle you have, is that a Twitter handle? I can't find it.
Yes, it's if I did, it's personal nuance, not finance, nuance. So let me go back to that slide.
Yeah.
It's same as my website, personalfinuance.com. Yeah.
Amit, Bharat here. Just do you think with the current US situation, with the mostly the kind of a political party changing, does it make sense to sell the stocks and save that capital gain tax of 20% or 19 versus 37% they're talking about it? Do you think it's a wise thing to sell all the stock and convert it now? Is the right time with what's really to come?
In the long term, your things will increase, but I would not recommend to sell everything you have. You have, well, for high income people, it becomes difficult, but let's say you have, somebody has low income, up to $75,000 of income. If you're less than that, you can sell stocks and the capital gains are 0%. So that's something very interesting to note. As soon as you retired, if you don't have any income, you can start converting some of your stocks from IRA to Roth IRA, or from high gains to lower gains. You can sell the stock and buy it again, try to get that luck, because up to 75,000 of income, you pay 0% capital gains. Even after that, capital gains is 15%. So I don't think capital gains will change. So be very careful of not selling anything that is short-term gains. Short-term gains will be charged at your maximum rate. And if Biden comes and he increases the rate, you'll be paying a lot of money. But if anything is 1 year or older, you can sell it at any time. I don't anticipate that Biden is going to increase the long-term capital gains to more than 15% to much higher. I think what he's going to do is change the income tax rates rather than the capital gains rates.
Yeah, but they're saying once if it comes that 37%, whatever the income tax, the capital gains is probably going to make the same as income tax. I guess that's the thing, right?
I doubt it is going to happen. So
Bharat, it's going to be Trump. Don't worry.
Let's hope.
You'll have ample notice before this happens.
Okay.
He's rooting for Trump.
I would not take any steps like that.
Okay. All right. Thanks.
Hey, Amit, one question. What's the rental yield in Portugal?
Used to be 6%, but these days getting lower in a place like Lisbon because of value appreciation.
Okay. So when it was a few years ago, it was about 6%. Let's say 2, 3, 5 years ago. How long?
Yeah, I think typically it was because a few years ago, what happened? Let's say 2012 was in Portugal was really down year for just after the financial crash. Portugal was very low in terms of stock market, real estate, asset price, and so on. So there are a lot of houses available on the market which are like old, 30 years old, 40 years old. Very low price. You get like $50,000. You will get like a very nice multi-story house with multiple apartments. You go and buy it. Since then, since 2012, they did the golden visa. But now the price have gone 3 times, 4 times of that price. So a lot of people have snapped up all those old properties and converted them to Airbnbs, or they've developed much nicer houses. So in those Lisbon and Porto, the things are going high, but outside still you can still find good deals. But outside Lisbon and Porto, the rental yields are going to be low because not a lot of people live there. So of course, the real estate prices are low, but the rental yields are also not high.
Okay.
So how much time did you spend? Sorry, go ahead.
Oh, go ahead, Ashish.
No, so Amit, how much time did you spend scouting the location, preparing for the retirement before you actually retired?
I think I've been looking for the last 3-4 years on where to live, what to do, and I got interested in Portugal, and as a tangent actually, because my wife is from Morocco, and Portugal is just across the water from Morocco, and it's closer to her home, and she wants to do some business in Morocco. So Portugal was a way for us to be close to Morocco and be able to have a 1 hour flight, go back and forth between Portugal and Morocco. And that's why I decided. And then as I look into it, it became apparent that the cost of living advantages, the residency advantages, the passport advantages. So all those things added up, and that's why I chose Portugal. But my thought was Southeast Asia. My first choice was I'll move to Southeast Asia, Thailand or some other place.
Yeah, Amit, you can choose not to answer actually. What's been the annual average returns for you with your investment so far?
That's a very easy question to answer. Just look at the S&P 500 return, and that's what I get. So somebody calculated 17% return. That's exactly the return I got. Because the beauty of investing in index fund is you're not chasing up returns.
That's what I was going to say.
That's what it takes.
Amit, that's what I was going to say. I thought I calculated it while Amit was talking about it.
Amit. Okay, let's ask the tough question, man.
It is correct. So it is about 17%, and I'm actually surprised. You know what? See, generally it's a common thinking that emerging markets have done well, but the reality is between 2008 and 2020, it's US that has rocked really. We've done really bad, and if you look at particularly in dollar terms, I think we're hopeless. Honestly, the Indian market has been hopeless in dollar terms.
Amit, just one final thing. I think you've got a Twitter handle wrong on the final slide.
Okay, I will send it. Send the
_nuance if I remember right. Actually.
Yeah, I will send a correct Twitter handle by WhatsApp.
Hey, hi Amit, it's Harish.
Oh, Harish, go ahead. Sorry.
Yeah, hi. Just one clarification regarding that index and ETF fund. So there is a view that this whole index as well as ETF is kind of some kind of a bubble because too much of a fund is chasing same set of stocks at a high valuation, and also like the index fund is more I would not say totally backward looking. It's more of a one which leaves out some of the things which might come in the index in future. So what's your view on that?
So this is a very good topic, and there's a lot of discussion ever since that divergence chart where I told you passive going high, active going low. There's people criticizing this approach and saying, and usually the criticism comes from the active fund manager. They say, so many people are buying index funds, all the money is going to index funds. People are not looking at valuations. So bubbles, it's creating bubble, asset market bubble in the top 500 companies, and other companies are not doing well. The other one, that's one. Another criticism is creating too much power in the hands of a few shareholders like Fidelity or Vanguard. Now they own stocks in majority of these companies. They own both stocks in Apple and Google, or they open a Shell and another BP. So they might say they have conflict of interest. They might force one company to do something else. So that's one. The other is it's gone up so far. It may not continue. But my overall view is that I don't think it matters as long as there are still a small percentage, even 5% of active investors. These are the people who determine the prices. So if something goes out of whack, if there's a bubble in some stocks and there is a big bargain to be had somewhere else, these active investors will do the arbitrage. They will sell the high price stock and buy low price stock until it balances out. I will send a beautiful article about this. I don't have enough time to cover it, but it says that if this happened and index fund ignored real gem, somebody like Apple would continue to, the price of Apple would continue to be $10 per share, but its returns would be $80 dividend per share, and it would not be an index. So when that happens, active investors will discover it, go and buy that, and will keep buying it until its price goes up high enough. And as soon as the price goes up high enough, that is going to go join the index funds. So it's going to be part of the index fund. And when index fund something goes, the money goes down, it's going to get out of it. It's self-correcting. So I will send you an article which talks about some of these arguments and the counter argument about why it's probably overblown and we are far away from that point where the inflection point where 100% of people are in index fund and nobody is doing price determination, trying to determine the prices. He says even if 5 to 10% of people are actively investing right now, and still much more than that, you still have an efficiently functioning stock market.
Nagesh, can I ask one final question? You can turn me off.
Oh, go ahead.
Guys, basically, anybody who wants to drop off can drop off, and I can stay here as long as possible. Anybody who has questions can ask questions.
I'm hearing that I'm hearing 2021 will be a bloodbath after the elections in the US. The dollar could be not the international currency of standard. There may be seismic shift is what I'm hearing, like the 1930s, right? After the World War II. It's a macro change as opposed to what happened in 2008, 2009, which is a micro shift. How do we prepare for it?
So I would say, like
ouch.
I think Amit's 4G Amit's hotspot finally gave way.
It was a tough question.
Just when I wanted to hear about what will happen when the zombies come.
Yeah. That's an interesting question, Umesh. That's the problem of moving to low-cost places, Amit.
The good thing is
that was below the belt, man.
So what, Gutti, what do you say?
No, that was below the belt, I said.
No, that's just a joke. I'm so sorry.
I know, it's good. Yeah.
Hey, while Amit joins, I want to hear why.
Gutti,
I don't know who asked that question. Why does the questioner think that?
Yeah, I know.
Smashy, I think we lost you in the.
Sorry, Smashy.
Yeah, so I was very interested in learning why the questioner thinks that. I forgot who asked the question. Was it
Umesh?
Okay. While Amit joins, maybe you can tell us why all that will happen.
Yeah,
because that's a great question.
See, the thing is, US has seen a lot of stability post World War II, right? We have been militarily the most powerful, economically most powerful. But if you look at it, civilizations go through that ups and downs. India was at its peak at one point also. So I think US domination will shift to some other country. UK was the most dominating power, right? For almost 100 years or 200 years. So US has gone through that peak for almost 100 years now. And people are saying that macro change will happen. I don't know whether it's true or not. It's predicting the future, right? But if it happens, the dollar as the international standard currency may be the first one to change, especially with Bitcoin and digital currency coming into play.
Yeah, that's really interesting because I hear that China is pushing digital currency as a state policy. And it's really unclear how that will play out. Very interesting.
Yeah. I think the Chinese.
But guys, digital currency coming in doesn't mean that dollar will be just vanishing, right? There has to be, if I have $100, then, and if digital currency come in, there has to be some way for my $100 to become a digital currency, right?
It'll become 40 rupees, right? Instead of 75 rupees. That's what will happen, is what I'm hearing.
Oh, so this will, with digital currency, the currencies will normalize across the world?
I don't know enough to comment, Saini. But
no, I think I am also curious because I don't know. I keep hearing about it, and I feel like whatever points you mentioned, that power shifting happening in geopolitically and all that seems it's not unfounded. There has been history and everything around this.
I checked out the Doshi session, Bose's session. That he shared on the group. He looks after international investing for DSP, I think, nowadays. From that session, my takeaway was possibly nothing is going to happen. That was even today, and I heard from other people also that US is still holds so much of power that really it's not going to happen. That's what.
Yeah.
I hope that too. I hope that.
I also tend to agree with that, Praveen. I think even if the change happens, it's not going to be sudden. It's going to be gradual, and we don't have to worry in our lifetimes. That's what I'm going to say.
So make sure you don't have to worry. And so you won't.
Or even if it happens, move your money to the strongest economy. If UK becomes stronger or China becomes stronger, move your money.
Hey, Umesh, there are a few companies in Pune, startups looking for investment. Those are safer havens there,
I know that was coming.
I cannot connect back. We have got some battery issues. So either we can continue talking or we can log out.
No, I think we'll wind up.